Hello, everybody, and welcome to our webinar on understanding financial statements. My name is Kenda Freeman, and I'm here with my co-hosts today, and forgive me, I'm a little bit on the nervous side. But I wanted to take a minute to thank our sponsors. We have EMC Insurance, Women in Surety, West Coast, and we also have Boss Bonds as our sponsors today. So I'd like to take a minute to thank them as well. And then I'll take a minute to introduce the three of us. Again, my name is Kenda Freeman. I am the Commercial Surety Sales Director here at Boss Bonds. I have approximately 10 years in the surety industry. Here at Boss Bonds, I work across the U.S. As a sales director, where I have a team of producers under me. I have a huge focus in teaching and training, and so I'm a licensed producer in several states and have a huge passion in surety and bringing others up in the surety industry, which is where I came into Women in Surety as the chair of education. Our first speaker today is going to be Heather Waldenmayer. Heather comes to us with a very strong background in financials. She has over 20 years of experience in construction finance, bringing together her public accounting background, private industry expertise, and leadership in various construction industry organizations. Through Elevated Advisors, she helps contractors strengthen their accounting departments, improve financial reporting, and gain confidence in the numbers they share with banks, bonding companies, and stakeholders. Heather is also ICCIP certified as well. And then we have our second speaker, and her name is Fariba Mehdian. She is also ICCIP certified. She also has an expertise in construction. And she brings 25 years of accounting and financial expertise as well. And she has a strong focus in construction, real estate, and manufacturing. So I look forward to this webinar. And again, thank you all for coming and joining us. Heather, I'll go ahead and turn it over to you.
Awesome. Thank you so much, Kenda, for that great introduction. And thank you, everyone, for being here on the very day that Taylor Swift announces her engagement. You chose to spend your time with us learning about financial statements. So I appreciate that commitment. As you heard in our bios, Fariba and I are both CPAs and CCIFPs. So we have prior public accounting experience, but now we both work with companies privately, particularly in the construction industry. So the content that we've prepared for you today is based on mine and Fariba's years of experience working directly with contractors and their sureties. But we also work with the board of directors of West Coast Women in Surety to try to prepare content that they thought would be relevant and helpful to you. So I recognize that we have a lot to cover during this session. So this is really going to be more of an overview, and we have built in time for questions. So know that this is just the first session in a 3-part series. We are going to go deeper into topics like the WIP and KPIs and red flags in future sessions in this series. So if after part 3 you want more education in other areas, we do hope that you would provide that feedback to West Coast Women in Surety, because we are always looking to provide great, valuable content to our members. But today, our focus is going to be on understanding what financial statements are really telling us. So how financial data is grouped, how we can use that data to analyze our client's financial position, and how sureties can work with this data to compare financial information across industry benchmarks and their other clients. Ultimately, the goal of today, in the words of Carly Fiorina, former CEO of Hewlett-Packard, is to turn data into information and information into insights. So when we're talking about financial statements, I think it's important to clarify what kind of financial statements we are talking about, because The types of financial statements that companies may provide, well, they could look very different, and it's important to understand the differences in the reliability in the information in those financials. So on future slides, I have included snippets of examples of each kind of financial statement, and I've also provided 2 downloads that hopefully you received via email last night, or perhaps we can put that in the chat below. But the 2 downloads that I have provided are a sample CPA reviewed financial statement from Eide Bailly LLP, which is a national CPA firm, and a copy of my internal financial statement template from Elevated Advisors, which is kind of our professional grouped presentation that we use with our clients to support internal financial reporting. These are provided to you so that you kind of have a better understanding of what good quality financial information could look like. But before we get into it, I think it's important for me to kind of clarify what I mean when I say good quality. So in this presentation, when I am referring to something that's a quality financial information, I'm referring to something that consistently applies GAAP. So in accounting, we have this thing called GAAP, Generally Accepted Accounting Principles. And that is these rules that accountants have to follow. So GAAP tells accountants how we need to report transactions. In this presentation, I'm going to use the word quality to mean financial statements that have GAAP and those rules consistently followed. So I've kind of ranked on this slide here the different types of financial statements in order of how consistently these financial statements may be applying the generally accepted accounting principles. In general, CPAs are considered the experts in application of GAAP. And so in order to maintain their ability to issue financial statements, that the CPA firms have to demonstrate their understanding and their ability to apply GAAP consistently. And so by default, the CPA prepared financial statements are always going to be kind of at the top of the peak here. But CPA firms can provide 3 different kinds of financial statements. They can provide audited financials, and those audited financials are where the CPA actually tests transactions at the transaction level, and they submit a report that gives the highest level of assurance that the financial statements are free from material errors and omissions. So that is the highest level of kind of quality that you can expect in a financial statement. But that process is quite arduous. As a former auditor, I can tell you on both sides, it is a pretty lengthy process, and it can be very expensive. And so for those companies who don't need that level of assurance, CPA firms can also issue what is called a reviewed financial, and that's the sample that I provided as part of the downloads. And so a reviewed financial is where the CPA sort of looks things over, does some analytical review, asks some questions, and makes sure, they provide some limited assurance that the financial statements are free from material errors and omissions. A CPA firm can also issue a compiled financial, and a compiled financial is essentially where the CPA firm takes all of the client's data as is. They give no assurance as to whether or not the information in those financials is complete and accurate, but they format that information into a GAAP basis financial statement, and it may or may not include supplemental footnotes and additional information to give context to those numbers. So even though the CPA firm is simply taking client information and putting it into, a nice, pretty format, it is still kind of ranked here in my rankings above internal financial statements because, again, the CPA firms are considered the experts in the application of generally accepted accounting principles. And so those financial, by default, should be more complete and reliable than even a well-prepared internal financial statement. So that brings me to internal financial statements. These are going to be financials that are prepared usually by the controller, the CFO, sometimes by the business owner. And whether or not GAAP, these accounting rules are consistently applied or the financial statements are complete and accurate is going to depend completely on the skill set of the preparer and their understanding of those accounting rules. And so you can have quite a spectrum in internally prepared financial statements, and that's where it's really important to understand your clients and their teams and their skill sets to, really be able to determine how much credibility their internal financial statements might hold. And then last but not least, we have tax return financials. So in a corporate tax return, there is actually a set of financials. And I know you're probably thinking CPA firms are often the ones who are preparing the tax returns, which is absolutely true. But again, my criteria was whether or not something had GAAP consistently applied. And tax return allows many different kinds of accounting methods and ways to calculate revenue or what is and is not an expense. And those tax rules are very different sometimes than the generally accepted accounting principles. And so if you are trying to compare a client's financials who's using something like the cash basis, which is acceptable for tax, but not under generally accepted accounting principles, if you're trying to compare a tax basis to industry benchmarks that are GAAP basis, you might get some pretty wonky results. So even though those are often prepared by CPAs, I did put them down below just because the results can be a little bit, inconsistent. So from a surety perspective, the more reliable the GAAP application or the more assurance that a CPA firm can provide, the more that having this financial data is going to offset risk, right? It's going to give more credibility to the company. The less reliable the GAAP application following the accounting rules, or if no assurance is provided by a CPA, there's just less offset to your risk. So it doesn't necessarily mean that things are bad. It just means the better the financials, the more credibility the numbers have, the more you can rely on them, and that might reduce your risk. Sorry, my lights like to go off when I'm not walking around. So in today's session, we're going to be talking about primarily the big three financial statements, and that is the balance sheet, the income statement, and the cash flow. In construction, we actually have a fourth financial statement, and that is called the WIP schedule. And the WIP schedule is kind of like the financial statement equivalent of ordering off of the In-N-Out secret menu. It is not always required under those generally accepted accounting principles, but it is often required by banks, sureties, and underwriters because the WIP schedule breaks down revenue and costs into individual project components. And so this additional level of detail allows the users of the financial statements to have context into how the company is able to manage their operations. So today we're going to look at each of these financial statements and we're going to focus on the information that they contain and how sureties can use them to compare client financial information consistently, apples to apples. And so with that, I'm going to turn it over to Fariba.
Well, thank you, Heather. Thanks so much for the wonderful introduction to the financial statements and what they include. So when we look at a balance sheet of a corporation, basically, we are looking at a point in time. It's like taking a photo of a company, say on December 31st, as we see in this example, which is a lot of time for closely held companies, is the end of the year, end of the calendar year. Majority of closely held companies are calendar year companies. Some could be fiscal year, but we see more and more of December year end. When we look at this balance sheet, this is normally one of the first reports that you see in a set of financial statements. And it basically telling us that from the beginning of time, when the company was incorporated to the end of this day, December 31st, whatever happened, this is the result of those activities. A balance sheet, as the name says, it has to be in balance. It's like a scale. On one side of it, normally on the left side, we have all the assets of the company. And on the right side, we have liabilities and stockholder equity. What it says is that the assets, the total assets of the company should be equal to the liabilities and stockholders' equity. Otherwise, this is not in balance and something is not working. Like Heather said, we prepare these financial statements according to GAAP, generally accepted accounting standards, and industries also have specific standards that they have to follow to have their financial statement, a quality financial statement. In construction industry, we use percentage of completion as a standard for recognizing revenues. However, that also affects our balance sheet, our assets and liabilities. So our assets mainly include cash and cash equivalents, any other liquid assets. So under current assets, basically we have assets that are liquid, meaning that we can convert them to cash in a very short period of time, normally less than 90 days. So for example, cash equivalents could include certificates of deposits that mature in 90 days. Other important current asset is normally accounts receivable. And this is when we are an accrual method of accounting. Basically, we are billing our customers, but we are not getting paid immediately. However, it is our money. We have earned it, and we are going to be able to receive that money from our customers. Another current asset item that is very specific to construction is retainage or retention. And what that is, when we bill our customers, normally they hold a portion of our money until the end of the project, until the project is complete. When it comes to commercial contracts, a lot of times we see a 10% retention. And public projects, especially in California, it's normally 5% of retention. We have earned that. That's our money. That's why it is in our assets. We record it as an asset. However, we're going to receive it at a later time. The other items in our current asset that we see that are very specific, again, to construction are over-under billings. The other terms that are used for these two is cost in excess of billings or billings in excess of cost. Those are the CIE/BIE that you see in the parentheses. The over-under billings, as we get to the WIP portion of this presentation, as well as our next presentation, next webinar, we're going to get really into the details of that. But that basically comes from where we calculate the percentage of completion on our projects. And if our percentage of billing compared to the percentage of completion of the project based on our cost, if the billing is less, then we are underbilled. And if the billings is more percentage-wise, we are overbilled. Again, we're going to discuss that a little bit more in detail in the next slides. The lines of credits are obviously a liability, and a lot of companies are required or encouraged to have a line of credit. If we don't have any borrowings on the lines, you're not going to see it on your balance sheet, but it's available when you need it. However, if you have drawn of your line and you have a liability, it's that amount of liability, but you owe on that line, is going to be included in your current assets. And then most construction companies have equipment, and they prefer not to purchase those equipments with cash, even if they have the cash, because they prefer to keep the cash for working capital and for day-to-day operations. So when they borrow equipment, they borrow on equipment. The portion that they are required to make payments towards in the next 12 months, it's basically considered current liability for them. and the rest is long-term. So if we are borrowing, say that we buy a vehicle and our term is 36 months, whatever our obligation for the next 12 months is going to be current liability, and the rest of it is going to go under our long-term liability. When we talk about working capital, it's really the difference between our current assets and current liabilities. And it's a ratio that's very, very important and of big interest to sureties, to the banks, because it's basically telling us how much liquid assets we have to be able to do our operations, to be able to have enough assets to meet our obligations. That's why we want our working capital to be a higher number. We want our assets to be larger of our liabilities, especially our current assets. There are other sections in the, Heather, can you please go back to the previous slide? Previous slide, yeah. So here, basically, we also have the non-current assets or our property and equipment. Many companies have real estate, and then, of course, construction companies, majority, like we said, have equipment. Those are not current assets. Those are not liquid. However, they're still assets. And then intangible assets that are not very actually, there, you don't see it in many companies. But it could be, if a company has a patent, or if a company is purchased by another company and maybe they paid over the asset value, then they may have goodwill or some other intangible assets. Liabilities we discussed, the current liabilities are basically accounts payable, any portion of the long-term obligations, the short-term obligations, and any accruals like income taxes payable, payroll, vacation payable, and things like that. And then, of course, the difference between assets and liability, the net of it is the equity of the company. It's like, think about your home. If you have mortgage and you sell your home, you have to pay off the mortgage. What's left in the company is your equity in that house. So that's the same thing. If we were able to pay all our obligation using all our asset, what's left for us is our equity, which is of very big interest, not only to the stockholders, but also to the stakeholders of the company. So the balance sheet is just the financial position and financial structure of the company at the point in time where it shows us if the company is solvent, is it in a good financial position at any given date. And I think we can go to our next. And the grouping, when we talked about cash and cash equivalents, that's normally they are grouped together as a one line item on the balance sheet. Prepaids are when we pay in advance for something. Say that we pay 25% of our insurance premiums at the beginning of when it's being renewed. That is not an expense, that's still an asset on our balance sheet. And then we expense it as we go. Related party receivables is a lot of times in a closely held company is when sometimes the stockholders, they need money for something else, so they borrow from the company, and it will be set up as an asset, but normally that is an asset that the sureties prefer not to see. Bankers don't want to see it. They don't want they prefer if they don't see any borrowings from the owners of the company. Accrued expenses are current liabilities like payroll accrual, insurance payable, if you have result of audits for the insurance, if you owe income taxes that you haven't paid yet, those are all current liabilities. And then, of course, we discussed the loans and the current portion versus long-term, which will be under our long-term liability. And the net of these are, again, our stockholder equity on the balance sheet. And okay, Heather, take over,
All right.
please.
Awesome. Thank you so much, Fariba. So as Fariba mentioned, the balance sheet is a point in time, but let's talk about the income statement. On the income statement, this is over a period of time. So if I were to run a March 31st financial statement for the month versus for the quarter, the balance sheet, like Fariba said, it's like taking a picture of a company at that point in time. The picture would be the same on March 31st, essentially, whether I ran it for the month or the quarter. But the income statement would be very different because the income statement is accumulating all of the activity for that period of time. So it's important when we're asking for an income statement, are we asking for the year, for the quarter, for the month? Because that will change the numbers that are reflected in the income statement. So the income statement, kind of how Fariba mentioned that there is a specific order to the balance sheet, the income statement has that as well. The income statement is going to flow in order of proximity to revenue. So we're going to start here at net sales, and we're going to go down to the cost of sales, which is essentially the cost of producing these sales, so direct kind of expenses. And we'll talk about this more in the next slide. And we arrive at our gross profit, the amount of money our productive activities earn us. We get farther away from revenues now. We're outside of production, and now we're in administration of the whole business. We are in our selling general administrative expenses. That leads us to our operating income, our regular operations of our organization. This is how much how well it performed. And then we get to these other non-operating items. So the farther we're going between sales down to net income, the farther we are going from generating the core mission of an organization. So I know what you're thinking. There's like 5 lines on this income statement, and you have probably seen client income statements that have hundreds of lines. And so as Fariba had mentioned, that is because of grouping. So internally, companies may track hundreds of different income statement accounts because this is how they are tracking various different types of expenses. They might track it by division. They might want to separate out, certain kinds of meals or, various levels of granular detail. Ideally, those accounts get grouped up into categories that would matter for external users. So for example, with my net sales, this is going to include all of the operating revenues associated with the company's core business or the core mission. So for a construction contractor, that's going to be their contract revenue via percentage of completion method of accounting. For service companies, that might be their service revenue, or for a manufacturer, that would be their product sales. This is going to be just really everything that they brought in from the normal course of business. And when we're talking about net sales and the things that get grouped in here, it's important to recognize actually maybe more so what does not belong in here. And so this is not going to include things that are generated from outside of the core company mission. So for example, if we are selling off fixed assets and we make a profit on those fixed asset sales, that would not be part of our net sales. That's actually going to go down in other expenses down here because it's not part of the core company mission. If I have a whole bunch of interest that, or sold off a bunch of marketable securities, unless you're in the business of securities trading, that's not part of your core business function. It's not going to be grouped in this area. Okay. So even though there may be other kinds of income, it might not be part of what you include in your net sales, because we want this to show the actual company mission when you're comparing trends over time as far as how a company might be growing. And then we have, remember, we're going kind of in order from proximity to revenues. The next area that we come to is going to be our cost of sales. And so cost of sales, these are the costs that are associated with the generation of revenue directly. This is production costs. Now, this can either be direct Or sometimes, particularly in construction, you can also see indirect cost of sales. So direct cost of sales should be all of the costs that are directly attributable to generating revenue specifically. Like you can identify the kind of revenue that those costs went towards. So for example, in a construction contractor, this might be a subcontractor who shows up to a job site on a particular month and they have sent an invoice for a scope of work that they performed on that specific project. So this is where we are doing job costing, and we can actually tag our expenses to a particular project. We know it's production related because it's a subcontractor, or it's the crew who is laying concrete, or it's the materials that were delivered to a job site. So these are directly aligned with the actual production. So as more revenue comes in, so might more direct expenses, because these are the costs of production. Similarly, but sort of different, is going to be your indirect cost of sales. So with indirect cost of sales, these are things that are still related to the generating of profit and are necessary costs of production, but may not necessarily be directly identifiable to a very specific project. So for example, using construction still as an example, if I have a project manager who has a fleet vehicle and that vehicle drives around throughout the county to check on multiple different job sites each day, the fuel that is used on that truck, where it's very difficult to be able to assign out like 0.2 gallons for this job, 0.3 gallons for that job. You're not able to specifically identify how much of that employee's gas tank went to each individual project. That would be what you would call indirect cost of sales, or also called overhead. In a manufacturing setting, the direct cost would be things like your assembly labor or your direct materials that are being used in production. The indirect cost of sales might be the large pieces of equipment and that are used for multiple different production lines. And those pieces of equipment have depreciation, they might have fuel, they might have maintenance expenses. Similar in construction, they also use large pieces of equipment. And so these are things that are necessary still to produce revenue. As you have more revenues, you might use your equipment more and have more maintenance, have more fuel, but it's not specifically identified or tagged to a project. And so when we take the total sales and we offset that total revenue by all of the costs it took directly to produce those sales, we end up at a line called gross profit right here. So this is sort of that first subtotal. And that first subtotal is the profit that is generated from the actual production of the company. How efficient is the company at producing these revenues by selling widgets or project profit margins? And understanding the trends in this gross profit number is going to give you insights into how efficient the company is at generating its revenue. So if gross profit is increasing year over year, that means that they're getting more efficient. If it's going down, it means that they're getting less efficient at the actual production of their product or their project. So it's really important to be able to understand these trends when you are comparing your clients to the industry or to their own historical performance, so that you can kind of identify what those changes in production efficiency might mean in terms of how it might impact their risk profile. So as we're going down, remember we're going farther and farther away from production and revenues, and we're getting now down beyond the gross profit here. We have our SG&A expenses, or selling general administration expenses, commonly referred to as SG&A, or you might hear your clients refer to it as corporate overhead. And so corporate overhead, this is going to be the costs that are associated with just having a business in general. It doesn't necessarily mean that you're generating sales because of it, and it doesn't necessarily mean that the more sales you have, you need more SG&A. These are sometimes referred to as fixed costs, although there might be some variability down here. But for example, a corporate office space. A corporate office space might be very necessary in terms of just running a business, but you could generate revenues without a corporate office space. And just having a corporate office space doesn't necessarily mean that I'm going to generate revenues. Like the two are not directly linked to one another. So that's kind of how we identify the difference between selling G&A corporate overhead from direct cost. Now, if I had a job site trailer, that would be rent that maybe I'm paying that is directly linked to a project. And so that would be cost of sales. So it's important to kind of pay attention not only to like the names of these accounts and the groupings, but also their function. And typically you can tell the difference between cost of sales and indirect cost of sales versus SG&A by the account numbers that a client might give you if their internal financial statements pretty much look like a spit out from their computer. So after we have all of these SG&A expenses, you know, we want to kind of look at the whole company now, right? What the actual core mission of our business, what does it take to produce all of our widgets or our projects? And what does it take to run the core function of our business before we get to any of the other miscellaneous stuff? That is going to be our operating income here. And our operating income is how well does the company execute its core mission? So its core business. If this number is increasing over time, it means that the core company is operating more efficiently or is generating more profit versus net income. So it's a little bit of a distinction because all of this up here is really the core business where this can include some other kind of miscellaneous stuff. So it's kind of important to recognize that, you know, when we're talking about benchmarking and we're talking about looking at risk profiles from a surety perspective or an underwriting perspective, the operating income is sometimes a very key number because this is the stuff that is kind of expected to continue year over year and is a little bit more comparative because it is something that is usually linked to management and the decisions that they're making or their team, and maybe less emphasis on external forces like interest rates or changes in tax law. And so it's a really important number. Once we get below operating income, accountants call that below the line. And so those are expenses that we call non-operating expenses. And the key distinction between whether or not something belongs down below the line is going to be whether or not that item supports the core mission of the company. So if the company is not in the business of selling equipment, right? They're not an equipment distributor or manufacturer, then when they sell, if it's a construction contractor and they sell equipment, that's not the normal course of their business. It does not go in that operating income total. It should be separated out. Same thing with interest income or interest expense, right? Those are things that are factors that are outside sometimes the control of the organization. And while interest expense might feel like something that is within management's control because they could borrow or not borrow, what we're trying to do is make the trend of operating income really linked to the performance of the organization, as opposed to the company's cash position, interest rates, fees, and things like that that might come along with it, right? If I have two contractors side by side, one needed to borrow money, one didn't need to borrow money, I still want to look at whether or not those companies' operations are working efficiently. That's why I'm going to separate the interest expense so that I have a more clear apples to apples view of these different items. So when we're looking at these things that go down into other expenses, another really key one that I think has been getting a lot of attention lately as the ERC credits have started becoming released and more of them are being paid out, is that companies who are still reporting their ERC credits, this is, again, not part of the company's core business. The ERC tax credits were a temporary program that were the result of laws made in Congress. So if someone was otherwise at an operating income level, was not profitable, but suddenly became profitable because they collected a whole bunch of ERC credit, that's great for them that they got that cash flow. but it doesn't mean that the operations of the company are as successful, right? So we separate that out because we want to separate the expectation in future years of how this company might operate. And those tax credits are not something that we can expect them to replicate because that was a temporary program. So once we take all of these revenues and expenses, everything from soup to nuts, whether it's the core mission or it's these other non-operating expenses, we put it all together, and that is going to give us the ultimate total of net income. And it's important to know that net income does not necessarily mean, like Fariba said, with receivables and prepaids and things like that, does not necessarily mean that this company has been paid for their work. So as a result, it's really important to know that there is a difference between how profitable a company might be on their income statement and how much cash flow a company might generate. Someone could be very profitable and have negative cash flow. Someone can have positive cash flow and not be profitable. And so it's important to be able to understand those differences. And so on the internal financial statements that I provided to you that I use for Elevated Advisors, you'll see that I already go through with my clients kind of a exercise to pre-group our accounts. CPA firms will also do this with their CPA prepared financial statements. But even still, we might show our income statements or balance sheets in more detail than you need for your benchmarking and your softwares and your analytics. And so when that happens, you might want to further combine information into your own categories. And an important thing to note when you're doing that, especially on the income statement, is that when you're grouping accounts, you want to keep accounts in their same overall section. So if you're looking at accounts within cost of sales, maybe there's cost of sales labor and cost of sales payroll taxes, and you want to group those into cost of sales payroll expenses, that would make sense, right? You want to try and keep your groupings intuitive and relevant. But what you do not want to do is you don't want to cross over one of those subtotals. So you might have cost of sales labor and SG&A labor. Those two things are not the same and should not be netted or added to each other in order to create categories. So you want to just make sure that at the end of the day, these totals and those subtotals, no matter how you might slice and dice the detail that goes inside of here, that these totals remain the same because those totals are very important. It's also kind of important to remember that however you are grouping these, like there's no right or wrong way necessarily, telephone and utilities or keeping those things separate. There's not a lot of like hard and fast rules about all of the different kinds of ways that you might group things unless your company has like an actual policy of the types of things you need to group. So if you have very like vague guidance or broad guidance, the other important thing to remember is just to be consistent. So whatever rules that you choose to follow, make sure you're always following those same rules. So that way, when you see fluctuations in numbers, you're comparing apples to apples. So if your firm likes to group telephone and utilities, or you personally like to group those two things together, then you want to be consistent and always group telephone with utilities for every single company and the same company year over year. So consistency is going to be really, really key when we're talking about using data to analyze and draw conclusions from. Because as we're comparing two companies or companies years over years, we want to be able to know and trust that the changes that we see from year to year or company to company are due to performance. And not just because one year we categorize one thing and another year we put it someplace else, right? So we want to be able to trust that consistency. And so with that, that is the income statement in a nutshell. And so with that, we're going to move on to the cash flow statement. And the cash flow statement is one that is near and dear to my heart. It is my email domain is construction cash flow because nobody ever went out of business because they had too much cash, but the opposite is true, right? We have seen, great recession, and even, it's always something that's kind of in the back of our minds as financial professionals, that companies don't fail because they didn't have profits necessarily. We have seen very profitable companies fail because they were unable to convert those profits into cash. So lucky for us, GAAP has given us a whole financial statement called the statement of cash flows. The issue with it is that you rarely see it in internal company prepared financials. Some software systems do calculate a statement of cash flows, but it is sometimes inaccurate. It's often inaccurate when it comes out of a software, but it's at least a good starting point. Where you will almost always find this, however, is going to be in your CPA compiled, reviewed, or audited financial statement. So if you're getting those, this is a really important financial statement to really be reviewing in a lot of detail beyond the balance sheet and beyond the income statement. Because the statement of cash flows is really going to explain the sources and uses of cash, right? Where is this company's money coming from? If you only look at a balance sheet and you only look at an income statement, you might see a wildly successful, huge profits company. And you might also see their cash increased from year over year and think, awesome, this company is doing great. But then if you look at their statement of cash flows, we might see that actually that cash is coming from a place we don't want it to come from. And so I'll explain. The cash flow is going to take us, starting with our net income, all the way to our cash change. So this is going to bridge that gap between profits and cash flow. And it's going to do that by walking you through the various different ways that companies can bring in money. So this first section is by far the most important. And this is the amount of cash that was generated or spent in the core function of the business. This is the operations, the actual business itself generated cash or it lost cash. And so it is very difficult for a company to sustain itself many, many years if the core function of its business loses money, right? Because that really should be going the other direction. But we also have this middle section here, and this is our investing activities. And so investing activities are things like the sale of equipment or assets. This is, we bought something, we held on to it for a bit, and then we got rid of it later. This could also be the purchase of an investment. So purchasing equipment, that could be a way that we are spending our cash. And so, if you have someone like that first example where someone was very profitable and they also had cash increase during the year, and you might think, awesome, this is a shoo-in. If you look deeper, you might find that maybe their operating activities was negative. Their core business is hemorrhaging cash, but they had a fire sale and they sold off all their equipment, right? And so money is coming and going from is critically important in evaluating the whole company. The last section is going to be our financing activities. And this is someone who has generated cash from taking on debt or taking on more contributions, asking their shareholders to contribute more money. So when we see cash flows coming in, like in this example here, it means that we borrowed more money. So again, kind of going back to how could someone be profitable and look like they have cash, but really be unhealthy? Again, if you have negative operating cash, but they got a huge loan to try to keep things going for a while, that can be a pretty dangerous situation and important for someone who is assessing this company's risk to be aware of. We can also have, going the other direction. So I might have a wildly successful company with tons of operating cash up here, but overall their cash might be negative. And that could be because they used those profits to buy investments or to pay out their shareholders, right? And so, this just provides additional context into the types of decisions that management is making. Because again, it's not about profit, right? Profit is the start of this whole financial statement. It's about all the things that the owners have done with that profit and how it relates to cash flow. And so from a cash flow perspective, this is going to give us some insight into the company's quality of earnings. And we'll talk a bit more about quality of earnings when we get to the KPI section, but also on the red flags training that we're doing in October. So the quality of earnings is going to be the company's ability to actually collect on the money that they are reporting as income. In construction, revenue is recognized based on the percentage of completion method of accounting. And the way that method of accounting works is it's relying on estimates. The company has to say, I think that this job might make a 30% margin when it's all done, and I'm halfway through it. So I get to recognize half of that 30% margin. That's great for them. But if they're not really entitled to that, they're not really able to bill it, they're not really able to convert it to cash, what good is that revenue? Right. And so particularly in organizations where you're relying a lot on estimates, and those estimates could be aggressive or could be conservative, whether or not someone can convert something into cash is going to be critical. Conversely, a contractor could be like really aggressive in their overbilling. They might front load their schedule of values to get huge deposits up front for work that they haven't even performed yet. They have earned $0 of revenue on that project, but they might be in a really strong cash position because they were able to collect that cash flow. So, in this example, the latter is actually more of a sustainable situation than the former, because at least you have the cash in the door and you're able to manage it correctly. Because in that first example where someone had a huge gross margin estimated but was unable to bill for it or collect on it, you run the risk of sort of the poison pill, if you will, particularly in construction, but really in any organization, which is you have to fund your work in advance. You have to pay the payroll. You have to buy the materials. You have to do the work in order to be able to get paid, right? You have to produce the widgets. You have to buy the inventory. You are at risk for those expenses until you are able to actually collect on your sales. And so someone can be profitable, but they could still fail if they're not able to collect on those receivables, convert the revenues into cash, and then ultimately pay their workforce and pay their vendors. So from a surety perspective, strong cash management is going to mean a stronger ability to complete projects. Right? And from a surety perspective, what do we not want? We do not want claims. We don't want projects where a contractor fails, walks off the job, or has to be replaced, right? The stronger a company's cash is going to be, the less likely it's going to be that they're going to fail. A weak cash management is going to increase their risk that something bad could happen or they could run out of cash. And so all of that is why I think the cash flow statement is one of the more important tools for sureties when you're evaluating whether or not a contractor's financial statements are sustainable and reliable. In lieu of having a statement of cash flows, however, Fariba had mentioned working capital. That's sort of the thing that I see sureties looking at often, but this is a good thing to kind of keep your eye on as well.
Okay, well, thanks, Heather. That was wonderful. All right. One of the schedules that we discussed at the beginning that may or may not be required is the work in progress, which is very actually, I think, near and dear to the sureties, and they want to see how this work in progress reports really, what kind of role it plays into the company and into the calculation of profits and revenues of the company. The one thing we need to remember in a construction environment, construction accounting, there is a difference between billings and revenues. Like if you're say that, you go to Walmart and buy something, you buy it, you pay it, and if you don't have the option to return that item, that money is immediately the revenue. However, in construction, just because we are able to bill, like just Heather mentioned, that money, maybe if we have a really good relationship with our customer and they allow us to overbill them and bill them in advance, that is not our money. We haven't earned it yet. It's wonderful. It helps us with our cash flow. However, it's not our money and it's going to appear as a liability on our balance sheet. So, looking at this work in progress report, what we are doing here, we are calculating how complete a job is. And the completion of a project is calculated based on our costs. So we calculate what percentage of costs we have put in as compared to what the estimated cost was. So let's look at our project number 1 on this schedule. We are saying that we have a $100,000 project and we are estimating to make $25,000 at the end when we are done. Everything is done. So a 25% gross profit is estimated. Say that we are on December 31, 2021, which is the first year that we are closing our books, and that job is still in progress. It has not finished yet. When we look at the total cost of that job at the end of that day, on December 31, and per our books, $45,000 has been put to that project. So the way we're going to calculate the percentage of completion is based on cost. The $45,000 cost divided by what we had estimated that cost to be at the end, which is 75. And that gives us the percentage of completion. In this case, being 60%. So regardless of what we bill on this project or don't bill, our revenues is going to be 60% of that contract amount. And you can see that under earned revenue column, we have 60%, which is really that 60% calculation based on cost multiplied by contract amount. If we had no billings on this job, we were late, our project manager didn't bill on time, or for whatever reason, our billings is 0 on that job at that day, it doesn't mean that we have 0 revenue. If that's the only job we have, our income statement is still going to show revenues of $60,000. However, because we did not send the bill out and we have 0 billings on it, let's say that's the case, we are going to have an underbillings of $60,000 on our balance sheet as an asset because we have earned it. Just because we didn't bill it, that doesn't mean that money is not ours. However, normally in a good environment, we shouldn't be not billing. We should be billing our projects on time. And this is a specific example. We were actually able to bill $65,000. So when we compare our billing at December 31 to what we had earned, there is a $5,000 difference. We were able to bill $5,000 more. And the difference in this case is overbillings or billings in excess of costs. And when we record our accounting, when we record it, that $5,000 becomes a liability on our balance sheet. And if we were underbilled, obviously that is an asset. So underbillings are assets and overbillings are liabilities on our balance sheet. However, underbillings are really not good assets. And by that, I mean, if the underbillings is only because, if the underbillings is because in reality, we are really behind in billings and we are going to bill immediately and we are all good, then that's wonderful. However, if underbillings is because we think we are 60% complete, because our estimated cost, in this case, $75,000, is really off. If we are not on budget, if we are wasting time, or we are buying a material more than what we expected to purchase, then we may not be 60% complete. So we are basically we may be underbilled because we are not as complete as we think we are. Or for whatever reason, the customer is not approving our bill because they are not agreeing with that completion percentage, or they think that we didn't do it according to design, according to code, which happens a lot in construction. So those estimates, the estimated cost, is really what's driving the revenue calculation. And of course, even the contract amounts are not, even in a fixed price contract, it is subject to change. You can definitely all of a sudden have a change of scope. And for some reason, whether the customer changes and they want to add something or reduce a part of the contract, that contract amount could go down or could go up. We could have change orders because there were things that were over, maybe the design was not correct. That we see that a lot. Architects do make mistakes, and or the customer changes their mind and they want to add something to the project. So those estimates are really, really important. And that's why we're saying billings and revenues in construction are not the same things. Just because we bill something, that doesn't mean that is our money. The other thing that I want you to really pay attention to, that billing to date does include retention. It should include retention. A lot of times I have seen, and I'm sure Heather would confirm that a lot of contractors, the smaller companies, may not include retention in that billings. And basically they put it as net, but GAAP requires that to be at gross, include the retention. And then of course, retention becomes an asset that we will have on our balance sheet and hopefully be able to collect all of it when the job is complete and the customer agrees that the job's done. So that's what the work in progress actually is, and it plays a big role. And basically, it also has a very big impact, of course, on our cash flow, because if we are able to bill on time or overbill, it allows us to have more cash in the bank and be able to stay on top of the budgets and projects and not be late in anything. The other item that the sureties look at is really the gross profit. And we have an average gross profit, which is really the gross profit on all the jobs together. We also have gross profit on each project. And the gross profit on each project and the average, we want to be consistent. We hope that the type of work we do, we can stay on budget, because a lot of times when we go and bid for a job, say that we have a 20% profit in mind. We want to be able to stay on budget and hold on to that profit throughout the project. But unfortunately, a lot of times, especially towards the end of the projects are dragged for sometimes, just delays that happen due to many different factors, permits, climate, weather. So it affects our gross margin. So it's really important to have a budget, to track the budget, and to be able to negotiate with the customers if there is something that's, it's not our fault and out of our control, or if it's something that comes up because the customer is not doing their part. I guess this is basically what we talk when we talk about work in progress. And the other thing that we need to do, again, like that, we always reconcile the work in progress to our income statement and balance sheet. We want to make sure that the income, the revenues that we show on the work in progress report syncs with the revenue on the income statement. Of course, we always have also some projects that are complete. So normally in any CPA prepared financial statement, and hopefully in the internal, you see two job schedules. One is the completed contracts, and one is the work in progress. When you add the revenues for the period on those two schedules, it should add up to your revenues on your income statements. Same goes for the cost. The total cost on your job schedules should match the total cost of sales on your income statement. The timing difference is the difference between our revenues and billings again. At the end of a project, our billing and revenue becomes the same. If a project is done and we built $100,000, that was our billings, and the project is done, and we don't expect any additional costs, then those two numbers are the same and we're done. And again, it's extremely important that we have good estimating department, and our estimator basically have a good track record. And not only we bid the job with the right estimate and the good projects, we also stay on budget so that our work in progress report is reliable, and there are not a lot of fluctuation. One of the things that sureties really don't like to see is a lot of fluctuation, because then they really think that we don't know what we are doing. We don't know what our estimators are doing and why are they missing things. Obviously fluctuation, if it's positive fluctuation, then it's much better than negative. But a lot of times we see that companies cannot stay on budget, cannot keep on track, and there's a lot of change year after year, especially if it's a very large project that takes 2 to 3 years to be finished. And after this, I guess we are going to discuss some of the ratios that are key financial ratios are of big interest, and it's in basically the sureties are looking at these working at these key financial ratios and make decisions on how much bonding capacity can be granted to a construction company. Heather, do you want to start talking about this? Okay.
Yeah. So kind of going back to that quote from Carly Fiorina, it's about taking data and turning it into information and information into insights. And so these key financial ratios, these are once we're able to get data into a form that now makes it comparable to industry metrics or to company trends. So I'm not sure how many of you have a software that you're using or if it's your own calculations, but these are some ways that you can kind of look at information from various different financial statements. So, the whole point of a ratio is to be able to look at things from a different lens. And we'll talk about the different financial statements on the next slide. But also, before we go too far into this, I forgot to mention, if you have a question, we do have time for Q&A, and that Q&A is going to be after we talk about these KPIs. So if you have a question, please be sure to put it in the Q&A section of the webinar player so that we can address your question while we are on the call today. So I'll say my first favorite, Fariba, and then you can maybe explain your first favorite of your KPIs. But my favorite ratio is the quality of earnings ratio. That is this one right here. It's one that I think is not as common, but is said to have been able to have detected Enron, the failure of Enron. So the quality of earnings ratio became popular when Enron failed, because in hindsight, analysts realized that a company who was very profitable, but where those profits were not converting into cash, that is essentially a quality of earnings ratio below 1. So this is saying the operating cash flow, that first subtotal on the cash flow, divided by net income. So if they can't at least generate 1 year net income in cash flow, even if it's exactly one, that's fine to be exactly one. But if it's less, if their operating income is less than 1 year of net income, or even worse, negative, then that is a crucial red flag that they say would have predicted the Enron failure. So that would indicate low quality or unreliable reported earnings. And in construction, this is a really important one because, as Fariba mentioned when she was talking about the WIPs, so much of revenue is based on estimates, right? Their estimated revenue, estimated cost. And so I use the quality of earnings ratio to try to ferret out when my clients are maybe being too aggressive and whether or not we really need to have a chat about, setting realistic expectations. So that's kind of, I guess, my first ratio that I like. I'll let you pick your next favorite.
Okay, the working capital calculations, our working capital and current ratios that are basically, these are liquidity ratios, and it tells us how much of our current assets we have, and we can actually use that for our current obligations. So I think what I have heard over the years from many of the sureties and bonding agents that a lot of times the bonding capacity that are granted to construction companies is a multiple of working capital. And if I'm not mistaken, unless it has changed, I've heard it's always been about 10 to 12 times of working capital at maximum. So these two ratios and the current, so basically working capital is current assets minus current liabilities, and current ratio is current assets divided by current liability. So for example, in the current asset divided by current liabilities, if this ratio is less than, say it's less than 1, it really tells us that our assets is less than 1 times our current liabilities. So we may not have enough assets to meet all our current obligations. So it's really important that we pay attention to these liquidity ratios and making sure that these are strong ratios, especially in construction companies when for example, this current asset always includes current asset, accounts receivable and retention receivable. Sometimes the retention receivable is on the books, but it will not be collected for a long time. Depending on, for example, what type of subcontractor you are, say that you're a concrete contractor and you're building a vertical building, you may be one of the first ones that does the work, and then you have to wait until the whole building is done before you can collect your retention. So that's why yes, retention is part of your current asset, but also it's how much of it is it going to be collected in a shorter period of time, and also how much more current asset do we have than our current liabilities? Are we borrowing a lot of money and we may not have the ability to pay them on time? So that's why also having a line of credit is very, very critical, because we want to make sure that we have a line of credit available. Even though it's a liability, it's allows us to borrow when we need it, and we don't have to just be looking for money when we need money and then it's not there. Do you want to talk about efficiency ratios?
Sure. I was actually going to do the billing and collection indicators because
sure, yes.
Yeah. So I think kind of going with the theme of cash is king, and nobody ever went out of business from having too much cash. In order to kind of ward off any bad cash flow issues, these billing and collections indicators are good, not just to kind of understand the company's collection practices, but also sometimes gives us insight into estimating bias. And so the first one is going to be days in accounts receivable. So essentially, on average, how much of our AR is or how much of our revenue is sitting in AR and how long. So for example, I might find that my days in accounts receivable is 60 days. So on average, from when I bill something to when I collect it, I have 60 days. And so when I have a client who is having trouble with their operating cash flow from their cash flow statement, or their current, their quality of earnings ratio, and so are really working on trying to build that cash flow up, I like laser focus in on this days in accounts receivable, because if we can move that up, if we can get their collections practices to be more efficient, if we can encourage them to get change orders approved, or figure out what is holding certain payments, obviously not retention and things that they may not have as much control over. But if there's anything that we can do to move things forward, then that will significantly improve these cash flow indicators. So if I start to see, I'll benchmark this. If I start to see days in accounts receivable ticking up, then I start to worry that we're having a problem or our clients are having a problem. And if I start to see the days in AR tick down, then I know that we're actually getting better at our billing practices. And similar to that, but also helps me identify an estimating bias, is cost in excess. Remember, this is the bad asset Fariba was talking about. This is the amount of revenue that a client's not able to bill for. This is the cost in excess as a percentage of billings in excess. So how much are you underbilled compared to how much you are overbilled? So if you have an amount where the contract assets are much larger than your contract liabilities, it means that you are lending your clients money, because you are putting all that money ahead to pay your employees, to pay your material suppliers, to do that work in advance without being paid, right? The client is essentially extending credit to their customers. And so you want to kind of be able to balance how much credit you're extending to your customers versus how much credit your customers are extending to you by prepaying for work that maybe hasn't necessarily been performed yet. And so when we see these, we want these things to be relatively balanced. If not relatively balanced, we want to be more overbilled, i.e. we want to be playing with the client's money, or the client wants to be playing with their owner's money, rather than pulling on their line of credit and exhausting their cash position because they're not able to get paid from their owners. The other thing that this can help me determine, if I look at this over a trend, is also help me identify estimating bias, because sometimes CIE can be a sign like that someone is taking more revenue than their client is allowing them to bill for. And my first instinct would go to why won't the client let you bill for that? Is there an unapproved change order? Is your estimate really aggressive? Because again, my big thing is, let's bring that money in. Let's get that project billed. Let's get that cash flow in. And so when we're met with resistance on like, oh, I can't bill that right now, the cash queen in me cries a little bit inside, because we want to be able to. And so we start to dig into that to try to really make sure that project teams are not overestimating the profit on their projects, or saying that they're going to get change orders approved that they might have no shot at getting that thing approved. So if I start to see this trend where it'll be pretty balanced, and then maybe a new project manager comes on board, or maybe the company gets into a tight spot and they really want to get a loan, and all of a sudden I see that thing shoot up because I start to see cost in excess as a percentage of billings, they're getting off balance, then I start to question whether or not the estimates are going to be more, are being manipulated or too aggressive. Fariba, back to you.
Okay, and I guess the final ratio that we're going to talk about are the efficiency indicators, which is basically return on equity and return on assets. And these are profitability ratios, and it is measuring how effective the company is generating profit. So if you have a lot of money sitting like in the equity section, say there's $10 million in the equity section, and we're only generating $100,000 net income. So we are not as efficient. This is capital sitting there that is not generating enough money. And the same goes if we have a lot of assets on the books, we have a ton of cash, we have a ton of other assets, but we are not really profitable. So it's like we are not efficient, and we don't know what we are doing, and we are not really using our assets efficiently. So these are profitability ratios that may not be looked at and may not be like as important to bonding or the other third-party stakeholders, but they're really important KPIs definitely for management, for the shareholders, and for the just financial position of the company.
Awesome. And I also saw some or a question come through on the Q&A. So we have about 10 minutes left in our time today. So if you have any questions for Fariba and I on any of the different, we know we covered a lot. Please go ahead. Now's the time. So you can go ahead and use the Q&A function to put those questions in. Fariba, I think this is a good one for you because it's balance sheet and WIP. What supporting documents, disclosure questions would you request to validate the accuracy of contract asset and liability balances? Like if they want to make sure it's reliable.
What supporting questions should we request to validate the accuracy? I mean, to validate the accuracy, first of all, obviously, you have to make sure, if you have to look at the trend of the company, if all of a sudden a company that was always like average gross profit is 10%, and all of a sudden on one of their work in progress report, they're expecting a 30% gross profit, then that's definitely a question that what's going on? How come this job is expected to make so much money? So these are the supporting documents. Obviously, as an auditor, we go and test the job cost and everything. I don't know if as the bonding or underwriters, you can ask for those documents. However, you have to look at also the fluctuations. If a job, I guess your client, if this is the first time, you want to look at their prior financial statement and look at the fluctuation of the projects, because say that they are estimating a project to be 30% this year, by the end of the project, which is maybe next year, they have made only 10% on that job. So you're going to see those fluctuations. That's why one of the things that we do as, CFOs, auditors in construction, we always look at project fluctuations on the profit. We compare year to year to see if the estimates were reliable. Does the balance sheet make sense? Okay. Again, having a lot of underbilling and clients saying that, oh no, I'm going to be able to bill, that I would question. Underbillings normally are not good assets, and we want to make sure that they're not overstating their revenues because they're showing underbillings.
Yeah, so and I'll add to that. I have been asked many times by sureties. I will get asked questions about this WIP schedule, and so some of the questions that we get are about these underbillings, right? It's almost as if they sort of go down this list and they with a highlighter and look for the big numbers and ask questions. But I also get questions about these. So like Fariba was saying, like looking for the trend. If the total company, like when we were talking about the income statement and that gross profit number, kind of how Fariba mentioned, like this should tie to the underbillings ties to the balance sheet, overbillings ties to the balance sheet, but earned revenue and costs and gross profit in the current year should also tie to the WIP. Like the WIP really controls a lot or has a lot of context for quite a bit. And so if the overall company financial, say revenues is 10%, like Fariba mentioned, you have your uncompleted, your WIP here, and you have your completed costs. So if all the jobs on their WIP is like 30%, 35%, but the total company profit is only 10%, then we can see like a mismatch, right? So I think one of the things that you would want to be looking at are things that are inconsistent, right? So if they're mostly overbilled and then you see some big outliers, that's inconsistent. If you have a company or most projects are 20% margin and you've got a 35% margin, that's 10% complete. Those are things that I think you would maybe like ask questions about. And I wouldn't like shy away from asking about them. Like I'm sure Fariba gets asked these kinds of questions all the time when, you know, sureties are working with our clients and have questions about, you know, how confident we are in these estimates.
Right. That's right.
All
Okay.
right. I don't see any other questions. So I think if you guys have any questions, you can, of course, email us. Our contact information will be here on the last slide. But with that, I'm going to turn it over to Kenda, who can kind of go over the future upcoming education items. Or did we lose Kenda? All right. Well, so
You're muted, Kenda.
Sorry,
Okay.
ladies. I appreciate your insight and your time today, both of you, in going over this for us. So again, thank you for your attendance in the webinar today. So we do have 2 other webinars coming up in our series. The next one's going to be on September 30th for Contractor WIP. That's going to be presented by Fariba. And so we'll go over the 3 things listed: contractor revenues, contract assets and liabilities, understanding the WIP as well. She's very knowledgeable in these areas, and this is a very helpful thing, especially for contract bonds specifically. So please join us. Look forward to that registration to come out shortly. And register for that event. The second event is going to be financial red flags. I know this has been a huge topic in Surety, something I'm very interested in as well. That's going to be coming out on October 30th. The registration will open up for that one as well. And that one will be presented by Heather. And so we look forward to that presentation as well. And yes, you will be able to have copies. Heather is going to share, Heather, correct, the copies that you had. She will be sharing those, so you'll be able to have access to the copies of the statements and such that she shared earlier. As far as the recording, I'm not sure if the recording will be shared or not. So look, Women in Surety West Coast page for the sharing of that, if that is eligible to be shared. So I did see those things go out. So I'm not sure of the answer to either of those questions on there. I did see those come through. So again, I just want to thank you, everybody, for coming. The next slide will show contact information for both Heather and Fariba. If you have any further questions for either one of them, please don't hesitate to reach out. They're very reachable, and we'll be happy to answer any of your questions.
Thank you.
Awesome. Thank you, everyone, for participating.
Yep.
See you at
Thanks,
the next
guys.
one.
Have a wonderful day. I look forward to seeing you next time.